My name is Bernard, and I'm with Insurance Advisors Direct. And like I say, this is our weekly Wednesday series of retirement roadblocks. But we're going to just take a little turn on this. And we're not going to talk about retirement roadblocks per se, but we're going to talk about how you can reach out to your Medicare book of business before AEP and either set up a Medicare review. And like I said, we'll have a little timetable. And then we have Brandon, who is our retirement roadblock specialist. And we're going to transition from the Medicare timetable into the lazy money and how you can access that money from when you're doing your Medicare reviews. So you say we're going to get started here. First thing on the agenda is our Medicare timetable. And what this is, it's going to show us, now, you know, there's a lot of rules to Medicare about reaching out to your clients before AEP, talking about Medicare. But here, all this is essentially talking about doing a Medicare review. And in this Medicare review, you can uncover a whole host of things because you're not talking about the specific Medicare product. We're just seeing if, you know, we'll go through the timetable. So first on the timetable is August through September. And with August through September, you can do postcard mailings using our IADs, Insurance Advisors Direct's preferred direct mail lead vendors, or any other vendors that you have for those that are turning 65 or over 65. And this will be then, you know, initial informative marketing material that introduces you to your services that you offer. Second, September 1st, which is today, you call your current Medicare clients. And like I said, you're not going to try to change anything. You're not going to try to sell them a new Medicare Advantage. All you're going to do is just go over changes to the client's prescription list, the doctors, or any other services. Then you'll make an appointment, if needed, for October 1st through the 15th to discuss what, you know, changes can be made. But you can't make any changes until October 15th. Remind them that you are their agent, and this is the most important thing. We want them to know that you offer as many services as possible, because we do not want a financial advisor or an annuity agent that is now in doing Medicare Advantage to, you know, talk to you about the annuity side, but then also get you for the Medicare. We want you to be that sole source. And then you can ask for referrals. And then some folks do offer $15 gift card for folks that offer referrals to you. Now, September 1st through 15th, and this is for your current book of business. You can mail an agency letter, and we can help provide you those letters, a flyer to all your active clients in your book of business, just letting them know that, hey, I'm your agent. Are there any changes that we can help you with, or has there been any changes? And, you know, just make sure you keep a list of all those folks that are interested. And we do provide marketing material for you in order to send out those letters. Now, October 1st, and here's a key one, because this is when all of Medicare agencies or Medicare Advantage companies, carriers, will say now you can show the public what we have. So call your clients on the list that showed interest in enrolling or making a change during AEP, and schedule an appointment after October 15th. So, you know, that's when you can start the enrollment. Now, October 1st, call on your book of business, those 65 and older, and offer a free evaluation of the current health coverage. Because now this is where you can talk about the product or the Medicare Advantage plan. You just can't enroll anyone. So also on October 1st, second round of postcard mailings. again, through one of IAD's preferred direct mail lead vendors, and letters to all of your book of business saying, hey, it's almost that time. I'm your agent. Let's work this out now. So when October 15th through December 7th comes, you can begin signing those enrollment and sending in those applications. But of course, on October 15th, you're going to make sure you're going to have those scope of appointments. So that is the timetable that we can use to market other services other than Medicare Advantage during now until October 15th. So what we're going to do now is Brandon's going to talk about, well, the different type of annuity products that you can use, or the services or solutions that you can offer your clients, because I'm pretty sure they're going to have that $25,000, $30,000, $50,000 just sitting there that not making a whole bunch of interest. The CDs are about 0.5, 0.6%. And Brandon, he'll go in here and maybe tell them about how interest rates of a fixed annuity or maybe a MIGA is a lot better than that 0.5, 0.6%. Well, Brandon, here, go ahead and take it away, my friend.
Awesome. Thanks, Bernard. Super excited. Thank you to everyone for joining us. As Bernard said, I'm going to go through, and my goal today is to give you some education. Just give you a couple talking points of a situation that currently exists out in the market right now that if you're talking to clients about, they're probably either feeling it or they're not even sure that it's happening, but it is. And even for yourself, as you think about your situation, what are some opportunities that are out there that you may want to consider, especially with what we're looking at right now when it comes to inflation and interest rates. I know for myself, my wife and I just recently took a look at this for part of our emergency fund and where we want to go for a short period of time. But what I'm going to share with you is first what and why. So right now, what we know is many clients have money, what's called sitting on the sidelines, and that's losing purchasing power. And our goal in this industry is to help people. And so what we want to do is, or what I want to do is share with you a solution that's going to allow you to help those clients get into a better place to secure their future. The other thing we know is traditional options, they can't keep up with inflation. I'm going to share with you some data that's going to show you what's happening right now. And it's really going to demonstrate the risks and kind of the concern that should be out there right now. And then finally, how you can help them really simply safeguard their future without necessarily locking in for a lifetime investment or locking in for a lifetime commitment, but some short-term options that you can share with them as you work with them on talking about Medicare and ways that you can support them here. So let's take a look right now at what's going on. So what you're seeing in front of you is the historical inflation rates from 1960 to 2020. And if you look at that, what you'll see is for the last few years, we've been in a pretty low inflation rate. In fact, earlier this year, inflation rates were 1.2, 1.4%. Not that big of a deal when you look at back in the 80s when they were up above 12%. And even down into the 4%. But what we know is the historical average of inflation is 3.7%. So if we've been down for a while and the average is higher, what can we traditionally expect? We're going to see some above average inflation rates to bring us back to the mean. If that's what the last 40 years have shown us, that's what we can expect moving forward for the next few years, logically. Now, when you look at what's going on right now, taking a look back at the last 12 months, look at what happened in March, April, May. We're seeing it. It's kicking up. We've had 4.2, 5, 5.4, and then repeated that again. So now we're seeing the above average inflation rates. And so what exists out there are is an actual risk to purchasing power, not necessarily numerical value, but purchasing value. So for example, if you think back, years ago when in the 90s, you went into a store and you wanted to get a candy bar or a pack of gum, it was 50 cents. 50 cents for a full-size candy bar or a pack of gum. If you walk into a store today, candy bar is going to run you probably about $1, and gum is going to be even higher. I think the latest I saw was on sale, you could get a pack of gum for $1.50. So what that means is clients that currently have money in a savings account, or maybe in a CD or a money market account that isn't earning as much as or close to inflation, they are seeing a dramatic loss in their purchasing power. If you put your money in a bank in the 1990s and you put $100,000 in there, today, 2020, you might have 105, 110, 120,000 even. It looks like you've gained. It looks like you have more money. But if you compare that to the inflation rates and your purchasing power, you actually lost money. It's an invisible risk that slowly erodes the purchasing power of clients' money. And it's especially prevalent when you look at folks that have traditional, or they remember the old ways of having safe savings. CDs, when CD rates were high, were a great option. You're not seeing that now. Savings accounts, same way. I'm going to show you, based on today's data, what are the top options out there. You could even go further and look at bonds. For the past 20, 30 years, bonds have been really strong. They've been in the 5 to 9% returns for a safer investment than stocks. But if you look at the projections and the forecast for where bonds are going to go in the next decade, I like to leverage Prudential's Global Investment Management. Everyone knows Prudential. They're huge, and they have a tremendous team that manages all of their internal investments. When they look at the bond market, what they're projecting as of Q2 or Q1 of this year, they're projecting a 10-year bond outlook of 1.8%. What that means is if inflation rates are 5, 4, 1.8 is not going to keep up. You're essentially losing every single year, but you're not going to see it. It just slowly erodes away your purchasing power. So as I said, let's take a look at what options exist out there for some of the traditional rates. This is as of this morning on bankrate.com. If you looked at some of the savings accounts that are out there, the best thing you're going to be able to find is 0.5%, maybe a little bit more, just like Bernard said. And if you look at the bottom, though, this means you got to have at least 25,000 in there to get these rates. If you don't have that much, look lower. So what's next? If we looked at savings accounts, let's look at money market account rates. Same thing. And it's, again, now you're looking at $100,000. You got to have even more to get just 0.5% return. If you looked at what happened in the last couple months, you had to have $100,000 just for the ability to lose 4.9%. It's not a great outlook, and it's not a great option. Maybe CDs. I mentioned that earlier. Let's take a look at those. Here's the best one-year CD rates. You put the money in, you let it sit for a year, you get, well, almost 0.75%. On the 2-year rates, you can get up to 0.8. That's awesome. Now we're only losing 4% a year. Okay. Well, what about longer? Let's look at the longer term. If I wanted to look at a 3, 4, or 5-year rate, now we're hitting the 1% range. But again, you're getting to 1.15 for a 5-year CD. You're still losing. So are there safe investments that you can't lose money, but you can keep up with inflation? Guaranteed? No, there's not. But are there options out there that can give you a guaranteed minimum, 0%? Zero is your hero still. You can't lose, but you have the potential to outpace some of these traditional options? Yes. Now, Bernard mentioned it, but one of the biggest option, or one of the biggest tools that we're seeing out there, and one of the biggest solutions, is the fixed indexed annuity. Now, you may have heard of annuities. I'm sure you have. Everyone has. And what they're normally used for is this income piece, right? I'm going to put my money in, I'm going to leave it locked up for 10, 15 years, and then I'm going to flip a switch and get my income. That's not what we're talking about here. There's a whole nother section of annuities that are FIAs that are either low or no fees. So what I'm going to show you is a no fee option. There's not one penny that the client pays. What it does is it gives them a short-term 5-year, just like these CD rates, where they can let their money sit, have zero risk, no downturn in the market, and the potential for higher returns. Now, if they need to access some of their funds, there are options for some withdrawals. 10% they can take out and they don't have to worry about it. But there's a ton of different products out there. And what I'm going to do is I'm going to share with you one example of one that you have access to right now, what it's doing today. And then I'm going to share with you the process of, if you're interested, if this is something where you may have clients that are sitting there with money on the sidelines and they're not sure what to do, you can talk to them about this option. And if you're interested in learning, I'm going to share with you the process of how Bernard and I can take you from right now, this introduction, to educating and learning about this specific silo of products that are available to you, and how the process goes where if you want to then present to a client. We've even seen a lot of folks, I myself included, we're talking to our financial advisor about these options for some of our rainy day funds. We've got a certain amount aside that if we need it now or something happens, we have access to it, but we've got some money we don't plan to use in the next few years, in the next 10 years. And we're looking at what are some other options that are outside of these conservative investments because they just don't look strong. But we don't want to take on risk. My wife and I are not very aggressive investors. We're conservative. And this fits right in there. So what I'm going to share with you is a product from Lincoln. It's really simple. And here are the current rates. And it looks confusing. So what I'm going to do is I'm going to narrow it down to show you some real life examples of how this works for clients right now that are looking at this. So before we start, as I mentioned, this is what's called an Opti Blend 5. It's a 5-year product. It means you put it in on today, which is September 1st, 2021. You're going to be able to have full access to do whatever you want with it. September 1st, 2026. This is a park it and decide what to do when things calm down and when you have, well, hopefully a little better idea of how you want to leverage this. You don't have to turn it into income. You don't have to give it away. It's simply a park and then decide. So it's a hold and see sort of position. So here's what I'm going to show you. I'm going to zero this down from all these index options because there are a lot of options out there. And Bernard and I will be able to help you talk through and understand what they mean when we go down and talk through the process. But I think most of us have at least heard of the S&P 500. And so that's what I'm going to zero in on today is what is this product done in the S&P 500? Now, on the right hand of your screen, you've got what has happened since July 30th, or as of, I should say, July 30th of this year. The S&P's had pretty strong returns, 17% just over percent. In 2020, it did 16.26%. And in 1 year, we're at 34.37% July to July. So folks that had a part of that action, I guess, are pretty happy. There's also an S&P risk control. So what it does is it stays a little behind the S&P, but it doesn't see the swings. Again, this is all tied to the performance of the S&P 500. Advisors, agents, clients, they understand that term. Whereas if I said, oh, we're looking at the BlackRock dividend accumulation index, who knows what that means? So let's stick to some very, very real stuff here. So on the left, you can see what's called the current rates for this Lincoln product. And that's as of this morning. So what this means is it's showing what is Lincoln offering for a client that puts their money into their OptiBlend 5 with again, 0 downside risk and an opportunity to earn. Now, are they going to give the client full participation and full credit for what the S&P 500 does? No, because that's not the goal of this. This isn't we're going to put it in and try to hit it out of the park product. This is we want to target 3 to 5% growth over the course of time. This is a slow and steady wins the race replacement or alternative for those bonds, those CDs, and that savings account. So the first thing I'll show you is right now their fixed account, 1.05%. So that means if you put the money in and walked away, just let it sit, you're going to get 1.05% this year, guaranteed. That's under 100,000. If you've got clients with more, the rates go up, but I'm going to talk smaller numbers right now, because if you have some clients that have 100, 200, 300,000 sitting in the bank, it's probably another discussion we want to have. So this is talking about the smaller numbers that are sitting there and they don't know what to do with, but they don't really want to lose it, but they don't plan to use, they don't want to lose it and they don't plan to use it. That's the fixed account. Now we look at that risk control of the S&P 500. What it says is you've got a 0.9% spread. What that means is the first 0.9% of the return doesn't count. The rest does. So this year, clients that are in that are currently up 4.92%. Is that capped? No. If the S&P 500 continues to go up, do they earn more? Yes. If it goes completely tanked and it goes down 20%, do they lose? No. Again, in this, 0 is your hero. No matter what happens in the market, because they're not actually invested, they are participating in an index, no loss. But clients that made this option or chose this are pretty pumped right now, because they are right there keeping with inflation and they have no risk on the table. To show you that I'm not cherry picking all of the rosy and best returns, let's take a look at the next one, the S&P 500 cap. So far, the S&P 500 is up 17.02%. There's a cap on this one that says 3.25%. So what that means is, as long as the S&P 500 returns above 3.25%, they get it. If the S&P crashes down and ends up year over year only up 2%, they get the 2%. If it's 3, they get 3. If it's down 40, they get 0. They get to participate in some of the upside with no downside. What's again nice about that is they don't have to worry about it. If they want to check what the S&P is doing, it's pretty simple. And these are pretty simple pieces to understand. And they can take a look if they want to see, oh, all right, we're still up. But they never have to worry about it down. You don't have to watch that. And then finally, the last one is what's called participation. And what that means is the client will participate in 10% of the S&P 500's return. So right now, the S&P 500 is up 17.02%. Client, 1.7%. It's slower, but there are some options that give more participation that's out there. But in this very simple example, here are four ways that when working with your clients to help them figure out, how do I worry about, or how do I try to keep pace with inflation? Here are four different options within one product that can help them do that. No matter where the client went, the likelihood of them beating a CD is strong. And this, again, no risk, no fee. They don't even pay an account fee to have it open. It's completely free. Now, I know most of us are motivated by helping clients and helping them understand, educate, and do the right thing. But what I'll tell you is, for helping clients have this conversation, you get paid as well. So everyone in this situation wins. And again, you're having the conversation that positions you as someone that isn't only concerned with helping them with their health, with helping them make sure that they maintain their retirement from covering their health costs. You can help them maintain their retirement when it comes to their savings as well. And that's the big goal, is helping people live the kind of retirement that they want. So what exists out there to help you? Well, one is, to have this conversation is not easy when you don't have the right tools or the right pieces to put in front of a client. So with Bernard and IAD, to simplify your success, what they've done is they've partnered to give you access to a presentation tool that's called an inflation report. This is just an example of one. It's an inflated example, but it helps show. And what it's showing is, if if inflation was average at 3.2%, the client was in one of these high yield savings accounts with $400,000, they're actually losing $10,000 of purchasing power every year. Over the course of 5 years, if they were looking at the product we just talked about and their savings account, in 5 years, if they didn't go this way, if they went the way of the savings account, at average inflation, they would lose purchasing power of almost $60,000. Now, when you look at the options of, well, I could lose 60,000 in purchasing power, or I could take a look at some options that can potentially give me a chance to keep up with inflation, the risk becomes a lot simpler. The conversation becomes a lot simpler. Even if they just did the fixed account at 1.05%, you can cut that lost purchase power in half. And it becomes something that they don't even have to worry about. It continues to help put them in a better place. For a very real example, again, if we put this at a 1% return instead of a 0.5%, the client has then saved $29,000. And they didn't pay anything more. They just moved it into something that gives them a better chance to keep up with inflation. So what does the process look like then? If this is something that you're interested in, that's the first step. This has got to be something where you're saying, you know what, that's interesting. I've heard inflation, I understand it, but I do think people need to know what's out there to help. If you're interested, great. That is step one. If you're not, that's totally okay. This isn't something that we're saying you got to do it. This is another tool in your toolkit. And so if you're interested, you go to step two, which is reach out to Bernard. And what Bernard will do is he'll set up a call with the three of us. And on that call, here's how it works. We talk about the concept, and you ask any questions you have about inflation, about the products, how they work, and we answer everything. Actually, step three can be a couple calls long, and it can take a couple weeks to get through. But the goal is to make sure that you feel confident in the concept, in the products, how they work. So when you decide that you want to talk about this with a client, when they ask you questions, you have a very easy way to explain something that could be complex if you don't know the ins and outs. I'm telling you, these things, when you start, they seem really complicated and really complex. You can break them down to a really simple walkthrough process of how they work. Bernard and I will do that with you. We'll even role play how to have the conversation. And we've done this lots, and we've had agents that have taken us up. We've practiced multiple times on, I'll be the agent, you be the client. You be the agent, I'll be the client. And we'll go back and forth so that you know exactly how you want to present that. And I'll share with you some best practices of how other agents and advisors that I work with are talking about this with clients. Are you going to win every case? No. But are you now coming to the client with something new and something that you can share with them to educate them and enrich your client experience? Yes. Does this become something that clients can talk about to lead to potential referrals? Yes. The idea here is not to try and sell a product. It's to have a discussion around what is out there. And the clients may say, yeah, I know that. I still like my CDs. Great. You've been educated, you know, and an educated client is a better client. That's good. They may have more questions. They may even go somewhere else. That's okay. But what they'll remember is you brought it up. And if they hadn't heard it before, the fact that you're bringing it up to them is going to cement in their mind that you're on a little bit of a cutting edge of some things that they need to look out for. As people talk about this, as they hear inflation on the news, as folks in the office or in their life talk about CD rates, bank rates, you're going to be the one that they think of because you brought it up first. And they're going to be able to easily transition to say, you know, I actually was talking to my agent about this. They brought up inflation too. Here's what they said. And the word starts to spread through the ties and the connectors that you have. Because I can tell you, connectors that hear this, folks that like to share your story are going to leverage this. I'm a connector, and I do it with books. I bore my wife to death with, hey, I read this cool thing about whatever, and it was about building habits. And you know, sometimes she picks up the book and reads it herself because that's the kind of interaction that people want, and it's a recommendation to share. Step 4 is an offer to help. It's not a pitch, it's not a presentation, it's sharing this information with your clients to say, if that's something that you wanted help with, I can do that. And that's it. If they don't want to and they want to go elsewhere, as we said, that's okay, but you're offering to help. Studies have shown that clients that have these interactions with their agents and advisors around offering to help rather than coming with a pitch or, hey, there's this new sale I got to make or this new thing I want to sell you, have a tremendously higher satisfaction rate. You can read the book. It's called Supernova Advisor. They talk about it in there. It's a huge value add for you and your client experience. Once you've done the offer to help, it's the busy work. It's everything you're seeing over on the side. Bernard and I got this on lock. We have a process. We know how to do it. We've got a suite of professionals behind us that can walk you through every single step of the process, through paperwork, through illustrations, creating those reports, making sure that all of the I's are dotted and T's are crossed. We got that. And we can walk you through it. You are not alone there. You don't have to worry about it. And in almost all cases, we can do it online. So you don't even have to worry about printing off 50 to 60 pages of all of the disclosures. We can help you through that. Step 6, when all of that's done, you get to go to your client and confirm the value. Hey, we got this done. Here's where you're at. Was this valuable? Great. Really happy I was able to help you. I'm looking forward to, as we continue on working with you on your Medicare. That's it. I thought I had something at the end there, but I didn't. That's it. It's that simple. So that's what I had for today. Again, step 1 is be interested. If you're not, that's great. It's very, very okay. If you're having the best year that you've ever had, and this is not something you need on the shelf, okay. But if you're looking to change your best and bring a little bit more to the table, this is a good place to start. And that's what I had. I'm going to turn it to Bernard because I know he's got something kind of exciting that he wanted to share as well. I know I overwhelmed with a ton of information. If you're interested, if step one's there, reach out to Bernard and we'll handle the rest. Bernard, it's over to you, my friend.
There we go. All right. Thank you, Brandon. And as Brandon was speaking, and we're always thinking. So, Brandon may at the last minute change something. So here I am, I'm thinking. So I have a little something, as an advantage to getting a fixed index annuity or an annuity. And an annuity is a life product. So offered by a life insurance company. So it has kind of a little advantage over a certificate of deposit. As Brandon was saying earlier, there's, that 10% penalty-free withdrawal that you can get, especially if it's non-qualified money. And then I'm not a tax professional, so I'm just gonna what I think. But by all means, speak with your tax professional. But like I say, it's tax-free. I mean, especially if it is non-qualified money. Then you're going to choose a beneficiary, and that's going to bypass probate unfortunately, if you pass away. So it's going to go straight to your beneficiary, just like if it were a life product. And then there's also some products have long-term care features that you can access that money if, and then I always get it mixed up. If you and Brandon can help me out. If you can't perform 2 of the 6 ADLs or whatever they call it.
Yep, activities of daily living. You got it.
Yep. So yeah, and that's the biggest thing. And then, like Brandon was stating earlier, we're with you every step of the way. Now we can't, be there with you when you're meeting with that client. For all of that back end stuff, we got your back 100%. And I know it's a deep learning curve. I'm having that same issue on the Medicare side because I'm an life and annuity agent thrown into the waters of Medicare. So I'm learning Medicare like you guys are going to be learning life insurance and annuities. So we just got to step out our little comfort zone a little bit. And if you're okay with it, it's cool. If you're not, that's cool. We're here. We're here for you and I'll always be here for you. So what we can offer you guys is for if you're looking for Medicare leads, and these Medicare leads can also be used. My apologies, I muted myself. These Medicare leads can also be used as annuity leads. So one of our brand new lead vendor that we have vetted and partnered with is NextGen Leads. And what we have is a little special for you guys. And I believe a $500 value gets maybe about 1,000 direct mail leads. So if you put in $250, we'll match $250, and there's your $500. I mean, of course, there's a little fine print to that, but I'll send all of that information out to everyone. But actually, this is a very good opportunity, and make sure that everyone gets that information. So yeah, if you're looking for those leads, good leads, those mailers, I mean, strictly yours. So $500 value, you do $250, we'll do $250 to match. And that's all I have for today. If you folks have any questions, please type them in. And I mean, we're ready to go. I mean, we're on our end, we're gearing up for Medicare for AEP, and I'm gearing up as well for the life and annuity sides. There's a lot of business to be had. So like I said, we know it's that small window up until AEP that you have to, maybe market some of these folks. But after December 7th, you can definitely market to your clients again. So we'll push for now, and then we'll push for after December 7th. We don't want you to get overwhelmed because we know that AEP is the bigger part of your business and don't want to overwhelm you with that. But come December 7th, if you want to jump in head first, we got you 100%. So Any questions, just let us know, folks. If not, please, here's my contact information. Reach out to me. I'm going to be reaching out to everyone that was on this call to see if you're interested, if you need any more information, because it is a sort of a process. But like I said, I want you stay focused on your Medicare, and then after that, we can focus on the life and annuities and get that going. So without that, folks, I see no questions. Brandon, thank you, my friend. We really appreciate it. And
Absolutely.
Folks, you have a great rest of your week. All right. Take care now.
Bye, everyone. Enjoy Labor Day.
Bye.